Guess most people believe that the economy is doing just fine. Stocks are hitting all-time record highs. Inflation is under control, we're being told, and the jobs number still looks okay on the surface, right? But beneath all of this calm facade that we see, things are really getting worse. And they won't tell you that. But here's the truth. Inflation just went up. Job growth is starting to fall. And new tariffs are quietly, very quietly in the background, driving prices a little higher. And then in Washington, D.C., D.C. is still shut down as of the making of this video. So today I want to break down why you should be worried right now. And more importantly, what smart consumers, smart investors, and everyday people like you and me should be doing to protect our money, our future, and our freedom. Let's jump into it. Now, I'm going to give you 4 main red flags. And here's the first big one. The first big red flag is inflation is back. The Bureau of Labor Statistics reports that the CPI for September rose 3% over the past 12 months. That's up from 2.9% the previous month. Okay. Now, core inflation, which excludes food and energy, also came in at 3% year over year. Now, on a monthly basis, month over month, prices rose 0.3% in this past September. Gas prices jumped 4.1% in September alone. And yes, housing costs, which many people hoped would cool off quickly, right? Housing costs are still rising, though there's some relief, right? The latest report from the owner's equivalent rent measure showed that rents increased only 0.1% in September, which is the smallest monthly increase since January of 2021. So there's a little bit of relief on the housing front. But overall, inflation is going up. Inflation is at 3%. So your dollar now today buys roughly 3% less than it bought a year ago. For someone living off of savings or fixed income, that matters a lot, right? The Federal Reserve's target has been 2% for its inflation for the last several years. So we're above it and we're sticking above it. We've been above it for a long time now, years. And because of the government shutdown, the data that we're getting is weaker. And the Fed is sort of having to make decisions with having sort of limited visibility on all the big picture of all the numbers at this point. So what should you do now about this first red flag, inflation? Listen, do a budget and take a good long look at your monthly spending. What do you spend on gas? What do you spend on groceries? What are you spending on utilities? You need to try to find maybe 5 to 10% of savings now before rising costs force you to have to take that look, right? That's how you get ahead of rising prices. You don't sit back and wait for prices to rise. You know they're going up, right? So if you know they're going up, do something yourself now. For investors out there, look, inflation at this level affects interest rates. It affects the bond yields, right? It affects valuations, right? The Fed is likely going to lower the Fed funds rate later in the week, right? And they're probably going to lower it by 25 basis points, which is 1/4 of a percentage point. But don't look for the stock market as an investor. Don't look for the stock market to jump because of that, right? It may not jump. It probably won't jump because of some of the things we're talking about on this video. So you should maybe be considering as an investor some dividend paying stocks or some type of securities that may protect you against inflation. Now, for those that are savers out there, holding on to large amounts of cash in these times is okay, but you always got to remember this. Your purchasing power of that dollar that you're saving is eroding at about 3% year over year right now. So you need to be evaluating some potential short-term alternatives to a regular savings account down the street at your bank. Maybe a high-yield savings account, right? If you can and you feel comfortable moving your money to get a little bit more ROI, return on investment from your savings, putting that money into a high-yield savings account. Now, let's talk the second warning light that you should be paying attention to, and that's the job market. Now, the labor market is losing steam, folks. Because of the shutdown, the Bureau of Labor Statistics official non-farm payroll that they like to report every month and their unemployment numbers that they like to report every month, all of that is delayed. Okay. Alternate indicators are suggesting bigger weaknesses in the job market. There's recent private reports that aren't affiliated with the BLS, Bureau of Labor Statistics, that shows weakening new jobs available and shows weakening or less hiring plans from companies. Those things are dropping right now. Now in August, guys, our last real report, non-farm payroll employment only changed by 22,000 new jobs. That is tiny, okay? And the unemployment rate did hold steady at 4.3%. But a lot of people anticipate that that's going to go up. Now, why all this matters in terms of the labor report and jobs? Because jobs drive income, right? And if job growth stalls, wage growth stalls, and consumer spending weakens, right? People spend less money, and a weak labor market usually is what comes before a broader economic slowdown or a recession, okay? Now, usually all of that is preceded by a bad jobs market. For investors and individuals, listen, risk increases when income stability is less certain. So a job market that's weak means that risk is going to increase for income stability, and that affects everything else behind it. Now, regarding the job market, what should you do? And what I'm doing here, guys, is I'm trying to give you not just what's happening, but I'm trying to give you practical things that you can do to be prepared. So if you're a worker in this society here in America, stay up to date on your skills. Build new skills if you can. Build side income if you can. But don't just assume that job security is going to be there forever, because that's not the world we live in today. You know, just ask the federal workers who are laid off right now about job security, right? We all thought, oh, you work for the federal government, you'll never get laid off. No, they're laid off right now, right? They're furloughed. Now, for business owners or investors, you need to re-examine the growth of your business, re-examine your hiring plans, re-examine your plans to expand the business, right? If the economy continues to slow down, discretionary small businesses are usually the ones who get hit the hardest. So you need to be aware of that if you're a business owner. Now, for the rest of us, we need to make sure we're building up buffers in our money and our personal finances, building emergency funds out maybe 6 to 9 months instead of just the typical 3 to 6 months, especially if you're in a job or a career that you know you've seen some layoffs and there's some instability there. You need a bigger cushion of emergency money. Just something to consider. Now, let's talk about the third warning sign. That's tariffs. Okay. Trade policy and tariffs are quietly, very quietly dragging on this economy, or at least starting to drag the economy a little bit. A lot of analysts estimate companies are passing 35 to 50% of tariff cost increases onto consumers, guys. Now, this is adding to that rise in inflation that I talked about a minute ago. For example, a tariff on an imported good that's coming into America, it may appear like no big deal on the surface, but when a company has to pay more for materials that are coming in or shipping things in to build whatever they're building or provide whatever they're providing, oftentimes that company, that cost that company incurs, it's passed on to me and you as the end buyer, right? The person who has to actually buy the item out of Target or out of Kohl's or out of, the grocery store, whatever. Listen, whether you agree with tariffs or you don't agree with tariffs, the bottom line is, how will tariffs ultimately affect our wallets, right? And I'm not here to tell you to like President Trump or not like President Trump or like what the Congress doing or sit on the left side or the right side. I'm not telling you how to think about any of this. What I'm doing is I want you to understand the effect that it's going to have on our everyday life, on our four walls, our budgets, right? Right now, the effects of tariffs have been sort of slow to come, right? We know that we haven't saw the massive surges in prices like many people were trying to scare us into early on when these tariffs were first announced, right? People were trying to frighten us into believe that tariffs are going to all of a sudden make a loaf of bread go to $10. That hasn't happened. What we have seen is a slight uptick in inflation recently, though, right? Based on the numbers. That's just the facts. Okay. Now, why this all matters to us regarding tariffs? Because tariffs can increase uncertainty for companies having to import and ship things in at a higher cost. And if margins shrink for businesses because of tariffs, hiring is going to slow down. Growth is going to slow down. And then ultimately, you'll see that tick down to the stock market. that may slow down. So all of this stuff is sort of tied together, right? That's just business 101. It's not politics. What we should do right now in terms of tariffs, right? As consumers, if you're planning on any big purchases, electronics, furniture, cars, whatever it could be, you need to price them now, or you need to wait for sale opportunities. Compare domestic versus imported goods as well in terms of what you're purchasing. Maybe you make it a note to do Christmas shopping, right? If you plan to do Christmas shopping from American-made companies, as opposed to companies that have their products made somewhere else. Maybe you can get a lesser price. It's just a thought, right? Things that we can do. We got to start thinking practical as consumers. Now, in terms of investors, when it comes to tariffs, pay attention to companies with high import exposure. Companies that have to import a lot of their goods in, we may see an increase in prices, and we may see less demand because of that increase. And also, you want to consider supply chain risk that may happen because of what's going on all around the world, a lot of turmoil that's going on throughout the world. You need to consider how the supply chains are going to be affected and ultimately affect that business when you're buying stocks or looking at stocks to purchase. And for us everyday Americans, look, recognize policy risk is economic risk. Okay. It can hit your wallet very subtle, but in meaningful ways that you don't pay much attention to on the surface. But when you look up, it's $20 here and $30 there. Now, the fourth major concern that I think we need to be considering is the ridiculous federal government shutdown and the ripple effects that are mounting every single day because of this government shutdown. Listen, the government shutdown began back on October 1st. And it's already caused data releases, as we talked about, to be delayed. Not to mention the 1.6 million people that are not being paid as federal workers, 900,000 of them furloughed, and another 700,000 of them working but not being paid. Analysts are estimating that each week that this shutdown goes on, it may subtract nearly 0.1 percentage point from our actual annual GDP. That's a ton, right? That's like $7 billion per week, or maybe more, from the gross domestic product. Now, beyond the numbers, you got your furloughed workers, you got your stalled contracts, you got your delayed benefits, you got weakened consumer confidence because of what's happening in Congress. All of that is starting to add up. And why does it matter? Because you got data that's being delayed and undermining the Fed's ability to make their informed decision. You also have economic uncertainty that's growing, businesses that are pausing their hiring, and you got consumers that maybe want to pull back and stop spending so much money. And listen, when consumers stop spending money, this whole mechanism this whole machine that we call America comes to a halt. And you can think that as a consumer, you don't play much of a role, but that's your main vehicle for participating in this hamster wheel, is as a consumer. Now, when consumers begin to pull back and stop spending, everything stops. Okay. Even if this shutdown ends, the backlog and disruptions of all the stuff that have taken place is still going to have an effect. Now, what should you do now as a consumer? If you know of someone in your household who's depending on federal pay or federal benefits or even small business contracting with the federal government, get yourself a short-term buffer. Again, you want to build out a buffer just in case. We've seen where people have started to feel the pinch and feel the grind of this long government shutdown. So you want to be prepared. As an investor, be aware that growth tied to government contracts, defense contracts, infrastructure contracts, service contracts, all those things are going to stagger a little bit. And for all of us, look, recognize that political gridlock that's happening in DC right now with Congress has some financial ramifications, and some financial risk are associated with politics that's going on right now in Congress. So we have to plan accordingly. Guys, if you're serious about getting your money right, go grab my new book, Manage Your Way to Millions. It's not about getting rich overnight. It's about building wealth with purpose and with intention. You can find it on Amazon or go to manageyourwaytomillions.com. It'll walk you through the same mindset and same systems that helped me turn my financial life around. Don't just talk about freedom, learn how to build it. Now, let's get back to the video. Now, for everyday Americans, cut your non-essential spending right now if you can. This is just my suggestion. Assume that costs are going to continue to rise and that 3% increase in inflation is going to be 3.5 or 4% next time we have a report. Now, it may not go up that much, right? But just assume it, right? And act accordingly. Don't wait for them to surprise you with the numbers. Build and maintain liquidity anyway. Have 6 months or more of cash or liquid assets saved up that you can tap into just in case you lose a job or if job growth slows down or your hours get cut. You've got some breathing room. Delay any lifestyle upgrades. If you were planning a bigger house or a new car or some type of expensive vacation, you may consider pushing that out until the picture is a little clearer. Diversify your income. Latch on to that side hustle or side business. Don't quit your main business just yet, but also consider rental property and real estate, some other ways to diversify your money. Don't just rely solely on a job in these uncertain times, right? Those days are over at this point, as far as I'm concerned. It's just my suggestion. And if you're investing in the stock market, you may consider ETFs and index funds and stocks if you invest in individual stocks that are in sectors like energy and infrastructure, right? Those sectors that may benefit from some of this uncertainty that we're seeing, right? All of your investments don't have to be AI and tech. There's other areas that could win and benefit around here besides those. Now, don't panic if you're an investor. Don't panic at the noise you're going to see on the news and all the highlights and social media, but adjust for higher risk in your own personal finances. Avoid over leveraging in an environment of uncertainty and just stay the course in terms of dollar cost averaging. Now, your overall financial plan, you need to be evaluating your goals, evaluating retirement, evaluating and considering debt payoff, especially on the bad debt on anything that's not increasing in value. Also, double check your net worth target and where you want to be, right? Look, what if inflation stays at 3%? What if job growth remains weak? Look, if you're like me, you may want to consider paying off real estate or scaling your investments up. I don't know. Everybody's at a different place in their personal financial life and different ages and so forth. But these are things that we all should be paying attention to. Yes, the markets look just fine on the surface, and unemployment at 4.3% still looks okay looking at the older data, but the signs are flashing yellow. Inflation at 3% and going up. Job growth stalled and hiring freezes happening, along with layoffs in certain industries. Tariffs quietly, very quietly, slightly raising prices around you. And a government shutdown that pretty much undermines data, undermines public trust, and undermines any economic momentum that we had. Look, if you ignore all that, you might just assume everything looks really good and everything's going great until it isn't. It's getting worse, but I don't want you to be out here panicking. I just want you to prepare. So I hope this video gave you something to think about. 4 warning signs that you should be worried about right now, or at least concerned about. Look, if you want to stop worrying, grab my new book, Manage Your Way to Millions, at manageyourwaytomillions.com, and take my 4 Steps to Maximize Your Money course. Both are linked in the description box below. And share this video, smash the like button, and drop a comment below. I want to hear from you. Let me know what you think, or at least say, hey, I got value. Listen, the best person who's going to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.